Perfect. Figured it out. All right. Well, I'm going to walk us through the results of the 2022 audit. I passed out kind of a summarized high-level presentation here rather than flipping through the full audited financials. This will kind of help us hit the high points of things a little bit here. So if you flip into the first page where it says audit process and opinion, I always like to start out with just doing a recap. What exactly is it that we do during an audit? You know, what's the purpose of an audit? And as shown here, basically an audit consists of us obtaining your financial records from throughout the past year, and then we perform a number of procedures over this information. So inquiries with management, analytical procedures where we're developing expectations for what your revenues and expenses might be based on industry trends or prior year trends, comparing that to actual results. And then lots and lots of detailed testing. So sampling, looking at invoices, looking at bank statements, reports from the county, from the state, et cetera, all for the purpose of being able to express an opinion on whether or not we feel that your financial statements are accurate. So the opinion that we've given you this year is what's called an unmodified opinion. So that is a clean opinion. That's what you've received in the past as well. So that's kind of the overall result of the audit. You got the clean opinion. The next page here does walk through some other required communications. So this is really where we would tell you if we had any problems during the audit. So problems as far as seeing unusual journal entries or difficulty getting the information that we needed, or just anything unusual that we needed to report to you. This is where we would tell you about it. As you can see, nothing like that was listed up there. The audit went very smoothly. Information came in timely. Everyone here was really great to work with. The one new item we do have listed at the bottom of this page is that there was a new accounting standard that was implemented this past year. So it relates to the way that you're supposed to account for any leasing arrangements that you have. So the one leasing arrangement that we had to apply this to was your lease for the liquor store at the Spirits. So the idea behind this new standard is that in the past, when you pay for your lease, you would just expense it as you paid for it. Under the new standard, we have to look at all of the payments that are due over the life of the lease agreement and basically record a liability for the present value of all of those future payments. You put that on the books as a liability, and you also put the building on the books as an asset. So it kind of nets out to zero, but it makes things look a little different in the financial statements. Next page here, as part of the audit, we also look at your internal controls, which is your processes and procedures that are behind the numbers. And we always have a few findings that we need to report here. And the three that we have for you are actually very common and very standard with all of the cities that we work with. So starting on the left-hand side here, this is related to audit adjustments. So throughout the year, you, for the most part, keep your books on more of the cash basis of accounting. You know, you record cash receipts and cash payments as they occur. But then in the financial statements, we need to make adjustments for things like accounts payable. What do you owe at the end of the year? Capital assets. What kind of assets did you buy during the year that we need to capitalize and then depreciate? Things like that. So because we assist with those adjustments, we have to put this note in here saying that we did post-audit adjustments during the audit process. Now, the other two right in the middle there, under the internal controls section, those two are even more standard. The first one relates to a lack of segregation of duties. So this is because of the size of your city and the number of people that you have involved with the accounting process. It's just really not possible to fully segregate all of the different accounting processes to the extent that would be considered ideal. So it's something to be aware of, something to just know that you have certain people who have basically entire access to the accounting system. So try to implement oversight wherever possible. And then right below that, we mentioned that as a third party, we do prepare your financial statements, which is, we do that for every city we audit actually. So this is a very common finding, but the idea there is that when a third party is preparing your financials, there's a slightly heightened risk that maybe a missing disclosure could go unnoticed, or there could be an error of some sort that would go unnoticed. And then finally, on the right-hand side there, we also do a review of your compliance with Minnesota statutes during the audit. So the Office of the State Auditor puts out lists of all the different statutes that they want us to look into during the audit. You know, how did you go about contracting and bidding, and how did you go about approving your payments, and what kind of investments do you have, that sort of thing. And we do have one item to report here as a result of that review, and it relates to a TIF reporting item. So when you start a TIF district, you have 4 or 5 years to basically report to the county auditor and let them know that, yes, the agreed upon activity under this TIF district did take place. And I think that reporting just happened a little bit late. It did happen, so it's just a timing thing, and it's already taken care of, but we did have to make a note of it in the report. Okay, with that, we'll get into the numbers a little bit here. I'm going to start out with a few slides looking at the general fund, since that's where the vast majority of the activity of the city occurs. And we're going to just take a really high level look at first, looking at 2018 through 2022, revenues in the blue, expenditures in the red, and then that fund balance at the end of each year in the green. And then we also have the 2022 budget on the right-hand side there. So really big picture for starters here. Revenues came in under budget by about $400,000. Talk about that in a minute here. Expenditures were over budget by about $49,000, but quite close in the scope of the overall budget. So overall, you had budgeted for an increase in your fund balance of about $552,000, but your actual increase was about $10,000. So at the end of the year, you're still hovering just a little over $5 million for a fund balance. Now, the next 2 pages take a look at those same revenues and expenses broken down into a little bit greater detail here. So first we have revenues, 2021 in the blue, 2022 in the red, and then we have the budget in the green. And you can see the biggest difference, what's causing that difference on the budget or on the revenue side compared to the budget, is really related to taxes. And I think this is just a way that you set up your budget on the revenue side for taxes versus how you actually record things. I believe what's budgeted here is basically your levy for the entire city, whereas a portion of that gets coded into debt service funds. So when the money comes in, some of that revenue gets allocated to different funds, and it creates a little bit of a budgetary difference here. So the difference from budget on the tax side is about $608,000. That's pretty close to what you actually received for property taxes in your debt service funds. Outside of that, everything else here was pretty close to budget. You had some additional COVID funding and police and fire aid that came through, but nothing too significant to note here. Next page, same layout, looking at the expenditures. Across the board here, nothing real significant that's standing out. General government, you came in over budget by about $51,000, but it also came in under budget by around $48,000 on the public safety side, so those kind of wash. The biggest difference is on the far right with capital outlay. You had some additional purchases of equipment, and I think you had a large mower of some sort that was purchased during the year that pushed you above your budget. About $82,000 different there. And the next page, here we take a look at your unassigned fund balance. So your fund balance in the general fund, portions of it can be restricted or committed for certain purposes. This is looking at the unassigned portion as a percentage of your annual budget. So you have a policy in place where you're trying to maintain a minimum here of at least 100%. And you can see you're well in excess of that percentage. A slight decline over the past few years, but the decline here from 2021 to 2022 is really just due to your expenditures growing. You had more expenditures in your budget, so this ratio is obviously gonna drop off a little when that happens, because your fund balance did hold pretty steady from 2021 to 2022. And then the next page just shows you cash. You just want to see what your cash balance is over the past 5 years. This one shows you that. Now, there is an explanation for that drop off in cash that you see here at the end of the year. Keep in mind, this is just at a point in time at the end of each year, so it is going to jump around a little bit. But what's really going on here is that you had a couple capital project funds, your Gull Lake Trail, and then the County Road 77 Nokomis Roundabout. Now, those capital project funds actually ran negative with their cash at the end of the year. So because they had a cash deficit at the end of the year, we can't show it like that in the financials. We have to show it as those funds borrowing from the general fund. So if they're borrowing from the general fund, then that's what's causing this decrease here. If you exclude that, your cash actually went up by about $100,000. Okay, so that's it for the general fund. Next couple pages here, we'll touch on some of your other larger funds. This one here takes a look at your debt service fund and then your other non-major, smaller governmental funds kind of all wrapped together. Debt service activity, very standard. You know, you have your revenues coming in from taxes. There's that tax revenue I was talking about earlier. Expenditures for principal and interest payments on your long-term debt. Overall, pretty close to breaking even, increased about $30,000. That's pretty much how that turns out every year. Non-major funds, this is the biggest funds in this category would be your fire fund, parks and rec, community service. Overall revenues there of about $269,000, expenditures of about $820,000, and then you did have transfers in, that's the other sources. That's transfers mostly from the general fund. For an overall decrease in that category of about $183,000. Next page shows the cash over the past 5 years for those categories. Starting with the debt service fund in the green, you can see that it's kind of been on a steady increase over the past few years, up about $31,000 from 2021. Hopping down to the red, the non-major capital project funds, you don't really keep much cash in these funds. And in fact, if we were to account for the fact that these funds owe the general fund about $344,000 at the end of the year, this would be a deficit if we were to present it that way. So there's really not much cash in these funds, and in fact, they do owe the general fund at the end of the year. And then your other funds in the purple there basically increased to about $45,000 in aggregate. All right, down to your proprietary funds, or your enterprise funds. So liquor fund for starters, the graph here is focusing mostly just on operations, looking at the past 5 years, operating revenues versus operating expenses. You can see an upward trend there on both consistently over the past 5 years. Revenues compared to last year, up about $115,000. Expenses, on the other hand, up about $374,000. Now, a portion of that's related to wages, but then a good portion of that, about $100,000 of that increase, is related to pension expense. So in these proprietary funds, the state, the para pension plans, they push out what's called the net pension liability, and they make you record a portion of that. And when you record a portion of that and it changes from year to year, you have to record pension expense. So it's a non-cash expense that's on the books this year for about $100,000, and it's that's $100,000 more than what it was last year. So that's what's causing an increase there.
And Ryan, this is a combined pickle and spirits.
Pickle and spirits combined, correct? Yep. Next page, same layout for the sewer fund. Once again, focusing on operations with the graph. Overall, you had operating revenues that were about $97,000 greater than last year, and operating expenses here were up about $269,000. Now, the story here is a little bit different. You had your wastewater treatment facility project that wrapped up at the end of 2021. And that's when it was essentially placed into service, and we start depreciating that large asset that was put on the books. So with that being put on the books and depreciation starting, there's a lot more depreciation expense being recorded each year. And that accounted for about $150,000 of this extra expense. About $50,000 related to that pension item that I just talked about on the liquor fund side. So about $200,000 of that increase was non-cash. And that explains why, if we look at the next fund here, or the next page here, both of those funds are still having increases in their fund balance, or in their cash balance, I should say, over the past couple of years here. You can see up about $112,000 in the sewer fund and up about $197,000 in the liquor fund. All right, and then I have a couple pages in here that just kind of show your debt service requirements for the next several years, actually, until the end of all of the debt that you have outstanding right now. So I have the split out between debt that's being financed with your governmental funds. So this is debt that's being financed by basically property taxes and special assessments. You can see the debt service payments are up around $600,000 per year for the next couple of years. And then they do start to drop off pretty significantly until about 2027, where they level out again there. Now, the next page here, same thing, but for your proprietary funds. So this would be your liquor fund, or I mean, your sewer fund, essentially. So this is debt that's being financed by those utility charges. And that's pretty consistently around that 300,000 mark until about 2040. So for the foreseeable future here. And then I threw one extra slide in here this year to talk about yet another accounting standard that's coming down the pipe. So I talked about that new standard for the leases earlier, and how we basically had to put a liability on the books for those future payments. Well, there's a new standard that's going to go into effect this next year for subscription agreements. So if you're having some sort of software subscription for antivirus or your utility billing system or for your accounting system or any other sort of accounting or IT software program, you look at the future payments due under that arrangement, and then we have to put that on the books as a liability and record an offsetting asset. So it's similar to the leasing standard that we just implemented.
Ryan, do you anticipate that will take a little bit of work on the front end?
Yeah, you know, one thing I should mention about that is that it's only required in your funds that report on the full accrual basis of accounting. So which would really only be your sewer fund and your liquor fund. So we'll have to look at what kind of software subscription type arrangements you have that get coded to those funds, and then we can go from there. So it may or may not have a significant impact. Any questions?
None.
Okay, good.
Thank you very much.
I'll just take an opportunity.
Ryan, how long have you been doing the city's auditing, your company?
Oh boy, six, seven. Yeah, you've been around the whole time. I was gonna say background when Lori was the administrator here was when we first started doing it. It's been probably 6 or 7 years.
So have we been doing well over the 7 years?
I believe so. Yes, I think the audit goes much smoother these days than it did in the beginning. So as far as just
Just
being,
because you've been doing it with us longer?
no, not necessarily. I would say it's the way that the information's gathered and prepped for us, and just the communication is when in the beginning things were a little harder to get the information that we needed, and maybe there was just a little bit of a disconnect on what we were looking for versus you know what they had been requested in the past during an audit. But I think the management team that we work with now does a really nice job getting everything that we need in a really timely manner.
So they're easy to work with,
They're easy to work with.
knowledgeable.
Knowledgeable, yes.
All right.
Yeah.
If I could, I just want to thank Ryan and his team for another very smooth audit. It's always a pleasure to work with you, and we appreciate your continued support and help with all of our questions and things. And thanks to Maggie for a lot of her work. She puts a lot of the work papers together and gives them a lot of the detailed paperwork that they need. So it was another good year. Thank you.
Thank you.
Thank you.
We will approve the audited financials during the regular meeting.
Okay, I'll hold unless there's any other questions anyone has, we can adjourn and re-adjourn at 7 PM.
Mr. Mayor, I'll make a motion to adjourn.
All in
Second.
favor?
Aye.
Okay, we're adjourned till 7.